which leads me to the glaring omission from the statement. Any indication of when the Fed will be ready to move rates off the 0 to 0.25% level, interest rate level? Omit. Wasn't there. But take a look at the Fed funds futures, the betting pool as to when rates will lift off. There is now, for July, a 75% probability that rates will begin to rise by that summer month. But guess what? Just about an hour earlier, it was at 90%. Why is Powell not ready to do this? Listen.
We don't meet the liftoff test now because we're not at maximum employment. If we do conclude that it's necessary to do so, then we'll be patient, but we won't hesitate.
Patient but won't hesitate. Let's bring in our Fed experts. Brian Wesbury, Chief Economist of First Trust, Michelle Girard, NatWest Markets co-head of Global Economics, and back by popular demand, the person who said this right here on yesterday's show. Here's what he said.
Fed is so far behind the 8-ball list that it's embarrassing. And I hope they catch up as soon as they can, but I just don't see it happening tomorrow.
And that's Andy Brenner, the NatAlliance Securities Global Fixed Income Head. All right, yep. So Andy, are they at least closer to catching up or still well behind the curve?
Liz, not only are they still well behind the curve, they're getting further behind the curve. You know, the idea of trying to bring transitory, not really addressing inflation. You saw a nice shift in the yield curve today, where at 2 o'clock, 5/30s were 7 flatter, and now they've reversed those 7 basis points, and they're now steeper on the day. So, I mean, what it tells you, and the stock market's picked up on this, is they're not going to raise rates anytime sooner. They're going to fight it as long as they can. The long part of the bond market, and they're not so happy about that. We'll have to see. Clearly, I'd love to hear what the other guests have to say about it.
Well, let's get to Michelle Girard. What do you have to say about that? And how does Jay Powell and the rest of the Federal Reserve justify rates at 0 without a definitive moment where he can say it's getting to be time when we look next year and say, let's go?
Well, I think the analysis is right. Initially, I think with the announcement of taper, maybe starting a month sooner, confirming it'll be finished by mid-year, you saw that I think initially, as you talk about the yield curve, the reaction was a bit of a flattener. But as the press conference went on and we heard more from the Fed chair, you could hear all the caveats. There was more of an explanation of why they were going to continue to move slow, why they were needing to be patient, the uncertainty they have not only about inflation, but about the economic outlook and the risks that the economy still faces, I think, in both directions. And I think that that's why you saw that curve steeping. In other words, you actually saw the market saying there's an acknowledgement that we aren't as confident about inflation being temporary, but we're not really stepping up the time frame for which we want to think about taking action on interest rates. So inflation expectations on the margin, I think, went up. That's what that steepening of the curve signifies.
Brian, inflation. Something really caught my ear, and I'm wondering if it caught yours as well. Specifically, he seemed to claim that inflation, the price hikes that we're seeing right now, are due to solely the supply chain blockages that we're seeing right now. I personally consider wage inflation part of inflation. People have to raise prices if they're paying people more. Look at FedEx, look at Procter & Gamble. So let's listen to specifically how he put it, and then I want your response, Brian. Here's Powell.
The inflation that we're seeing is really not due to a tight labor market. It's due to bottlenecks, and it's due to shortages, and it's due to very strong demand meeting those. So I think it's not the classical situation where you have that precise trade-off.
Is he right or wrong?
Yeah, no, I think he's wrong. Liz, this reminds me of the 1970s, and I have to tell you, I was young during the 70s, but I've read every economic report of the president. I've read many economic books from the 1970s, and the Federal Reserve did the same thing back then that they're doing today. They misunderstood where inflation was coming from. It's coming from the printing of too much money. It's not because of OPEC. It's not because of supply chain problems. It's not because we're buying goods and not services. It's coming from printing too much money. And then let me just add one other quick point. and that is the reason the Fed ever has to do quantitative easing is because the financial system is in trouble. Well, our banks have never been better capitalized. They've never been more profitable. We don't have a financial problem in the U.S. The reason unemployment is high or higher than it was is because of the pandemic. It has nothing to do with the Fed. So this idea that we need to be buying any bonds, or holding rates at zero today, it's just a justification for moving slow. And I think the Fed's going to have more and more and more inflation as the next few years unfold.
Andy, who gets the proverbial screw here? And I say that only because the savers have sat there waiting to get some kind of return on their money markets or their savings accounts. And again, year after year, this is not happening.
Well, absolutely true, Liz. But, as far as who gets the benefit, whatever, equity investors have been getting the benefit of this for the last few years, and it looks like it will continue for a bit. But I am looking for a correction sometime next year. But, rates are just way too low. Inflation is way too high. And Powell, no matter how he did or what you thought, he did the tapering part fine. But, this inflation, first he said that there's no wage inflation, whatever. And then he said wages are moving up very strongly. The supply chains are going to dissipate. We all know they're not going to dissipate anytime soon. And then he's calling it, we still need to put 5 million people to work, but yet he's calling it a tight labor market.
Yeah, what was
there's
that?
There's a lot of contradictions here, and I just can't explain them all.
Maybe Michelle can. Michelle, you said we don't have a tight labor market?
I am just as kind of baffled. And I guess I'm just concerned because I feel like the Fed is just looking at the world through the wrong lens. I still think they have some echoes in their head of the post-global financial crisis period, and there's just so little comparison, if any, parallels to that period. What's happening now is a completely different set of circumstances. So I still feel like they're scarred by that experience on the inflation front, which is having them be much too concerned about both the slowing of, the potential risk to taking action to hurting the economy, as well as the remembrance they couldn't get inflation up. But again, as you said, the labor market is tight. It's not a demand problem. It's a classic. There's absolutely no, I think, counter to the two mandates. We have a tight labor market because there's no supply. It's not a Fed-induced issue.
Brian, is the Fed scarred or blinded? And that said, may I just say we got the October ADP report. We added 571,000 private sector jobs. That is way higher than what was expected.
Yep, exactly. Well, going to Michelle's point, I think they are scarred and from the financial panic of 2008. But I think it goes a little deeper, and that is there are all these people who believe that the first rounds of quantitative easing, so we did QE1, QE2, QE3 from 2008 to 2015, and we didn't get any inflation. Well, this one is different because what happened back then is that monetary base, the quantitative easing, did not flow into the M2 measure of money. It never expanded the deposits in the banking system in a huge way. This time, right now, we have 36%, 1/3 more M2, that's deposits in all banks, today than we had back in February of 2020. You cannot increase the money supply by 36% without having inflation. It is so simple. He mentioned Milton Friedman today. Milton Friedman said, watch M2. Okay? I believe Milton Friedman was right, and I think Jerome Powell is wrong.
Brian, Michelle, Andy, you are the best of the best, gang. Thank you very much. We do. I mean, we can just simply say that it'll be great. As Andy said, for the stock market, you don't fight the Fed and you don't fight the tape. We are close to session highs right now for the Dow, NASDAQ, and S&P.